I've been arguing all year it's going to be, March, May, June or bust. Now it's pretty much June or bust, meaning that the next possible time that they would cut rates or raise rates, because I still think it's above 50%, is after the election, provided the data supports that view. Powell doesn't have the confidence inflation's going to 2%. If he can get that confidence by weakening data by November or December, then they could cut rates.
Jim Bianco, president of Bianco Research. It is so great to welcome you back on the show. And Jim, great to see you as always. Thank you so much for taking the time to join me today.
Sure. Thanks for having me.
I have to say, I think you're one of the fan favorites because I love having you on. I don't even know how many times we've had you now, probably like 4 or 5. I don't know. You're always a hit with the audience and one of the best minds when it comes to all things macro. And so I want to start there where I always start with my guest, and that is to get an update from you on the macro picture, where we are today, the framework in which you're looking at the world. And one of the things about this show, Jim, as you know, take all the time you need to set the table when it comes to that macro picture.
Okay, so to set the table, my macro picture is quickly becoming the consensus picture. The economy is doing better than people think. The data has been stronger than people think. That was not the case at the beginning of the year when everyone was talking soft landing, but that is quickly becoming the case now, even among Federal Reserve officials. All right, that's all good, right? Everybody's getting jobs. Things are looking better. Yes, but it comes with a cost. And the cost is stickier inflation. And that inflation, back at the beginning of the year, we were talking about it being on the last mile from 3% to 2%. But it looks like the last mile was 3%, and that we are probably going to trend sideways to slightly higher for the next several months in inflation. So that's going to be a problem. 3%, 2%, what difference does it make as to whether or not that number, it makes a big difference. And it doesn't necessarily make a big difference to everybody who's listening to us or us, because in the top half of income in the country, about 70% of the spending goes on in the top half. Top half of income in the country owns their homes. They have portfolios. They're going up in price over the last several months, both their homes and their portfolios. So if the inflation rate is not 2% where we want it to be, but 3%, no big deal. You might not like about what's happening at the gas pump or maybe at the grocery store, but you pay it, you move on with your life. If you're the bottom 50% of the country, according to bankrate.com, almost all of them cannot afford $1,000 in an emergency. They have to either borrow it or put it on a credit card or something along those lines. If the prices of stuff is 3%, not 2%, and they go to the store, the gas pump, and see that it is higher, okay, they pay it, but then they have to do with less of something else. They have to make a very difficult decision. And that is why you can have two things happen at the same time. One, I just said the economy's better, spending is going well, and it's giving us a little bit of inflation, but the economy's doing better. And two, if you ask in the political polls, what do you think about the economy? It says it's terrible. Remember, in the political polls, it's one person, one vote. So that person in the bottom 50% gets as many votes as Jeff Bezos. In the economy, Jeff Bezos gets the equivalent of 1 million votes because he buys, his third $90 million house in Florida alone or something like that last month. And so that counts for a lot of spending that a lot of people in the bottom 50% don't do. So that's how you can have both things being equal at the same time. So that's kind of my overview on the economy. Where I got to it is, that wasn't a consensus view earlier this year, but it's quickly becoming a consensus view.
Mm-hmm. So it sounds to me, Jim, we're talking about a bifurcated economy. Is that the way to characterize it?
Yeah, whether or not you own assets or you don't own assets. And the big driver of that is inflation. Because you could argue, well, wait a minute, bottom 50%'s never owned assets. Yeah, that's true. But the difference was before 2020, if you had an inflation rate of, say, 1.5% to 2%, which is what we did for a decade plus, if that bottom 50% got a 2% raise at their job or 2.5% raise at their job, to use the tennis metaphor, they held serve. whatever they bought this year, they can buy in the same quantities next year. Now, if they worked hard, they get a raise, they get a promotion, they can get to a higher level, higher living standard. But at least they would hold serve. But now, with this higher inflation rate, because of all of that spending, the bifurcated economy, the spending on the top half, they can't hold serve because these inflation rates and their wages in the last 4 years are not keeping up with inflation. Now, maybe in the last few months they have been, but that's just the last few months. And if I'm correct in that the inflation rate is going to start heading up, that might not be the case in the next several months. But for the last 4 years, their wages have not. So they've had to do with making difficult choices. If we want this, we have to do with less of something else. And so that's why I think that this bifurcated economy has produced those kind of inconsistent numbers. Everybody says the economy is terrible in the political polls, but the GDP numbers say that it's not.
That's so fascinating. Okay, so with this more persistent inflation, what do you think this means for interest rate policy? Has this shifted or reinforced your own outlook as it relates to interest rates?
I think it's already shifted. A week before we are recording, Jay Powell spoke in D.C. With Tiff Meechan, who's the governor of the Bank of Canada. In his early remarks, he said, we were looking for confidence that the inflation rate was going back to 2% to open the door for rate cuts. These are my words and what he was saying. And then he went on to say, we have yet to get that confidence. So rate cuts are done at this point. Now, there's some people talking about, even some Federal Reserve officials talking about maybe later this year, they'll revive rate cuts. But I think that they're largely done. What the Fed is not talking about is rate hikes at this point. I would personally put the probability of a rate hike, and let me be clear on what I'm saying here, at above zero, but way less than 50%. So I'd put it about 10 to 20% chance that they raise rates, 10 to 20, meaning I don't expect a rate cut, but I'm above zero on that number. I'm leaning more that way, but not enough to say that there will be one. The data continues to surprise by beatings, being stronger than people think, CPI, employment, retail sales, and the like, then those odds will go up. But I think that that's where we are right now. So for Federal Reserve policy, they're on hold probably until at least the election, if not a little bit later. Quick word on that. I've stolen a phrase from Claudia Sahm, the economist Claudia Sahm, that the Fed is not partisan, but political. Not partisan. They do not sit around the FOMC boardroom table and go, how do we get Biden elected? Or how do we get Trump elected if that's what they want? They don't do that. They do not do that. But they are political. Yes, we understand that there's a meeting on next week and we're not going to move. And there's a meeting in June. That door's still open to a rate cut in June, but probably not likely unless something changes in a big way. July 31st, that's between the Republican and Democrat convention. That is not the place to start a new Fed policy. September 18th, that is 7 weeks before the election. That is not the place to start a new Fed policy. As I like to joke, by the time you get to summer, the Fed wants to be Homer Simpson fading into the hedges. They don't want their name mentioned. They don't want to be discussed. If they cut rates at the July meeting or the September meeting, they become the focal point for both candidates. And that's where they don't want to be. So I've been arguing all year it's going to be, March, May, June, or bust. Now it's pretty much June or bust, meaning that the next possible time that they would cut rates or raise rates, because I still think it's above 50%, is after the election, provided the data supports that view. Powell doesn't have the confidence inflation is going to 2%. If he can get that confidence by weakening data by November or December, then they could cut rates. If the data stays like it is, there's going to still be no rate cut. What about interest rates? Long-term interest rates, they've been heading higher. We started the year at 3.88% on the 10-year note. We're at 4.65 on the 10-year note right now. So we're up about 85 basis points on the year. That's a big move in 4 months for the bond market. I think that rates are still going to keep going higher to like 5 to 5.5. I've been at 5 to 5.5 for several months, but I don't think they're going to go much beyond that, because I think for rates to go much beyond 5 to 5.25, that you would need the consensus to start thinking there's going to be more rate hikes. Because if the funds rate is anchored at 5.5 to 5.25, it really limits the amount of upside, unless the data just keeps going and we just look at each other in the markets collectively and say, look, they got to raise rates. This is way too fast. The inflation rate's going to get way too high. They've got to do something to try and slow this economy down. We're not there, but that would be about it. So I would term interest rates, to use the baseball metaphor, they're in the 7th inning of their rate rise, excuse me. There's still, if you know baseball, a lot can happen after the 7th inning, but you're most of the way through it. I think they're going to go to 5, 5.25. In other words, what I'm also trying to say is I'm not going to do the Wall Street thing. Hey, under 4%, you said it was going to be 5, 5.25. You got it right. So now what? Oh, I'll go with 6. No, I probably won't. I'll say that's the move. And now we're going to trade sideways down unless data changes. It gets much stronger than I think. Crude oil prices have a supply constraint and spike way up, well over $100. I think that's bearish for bonds. I know a lot of people think that's bullish for bonds, but it isn't happening. But if something like that happens, I would consider changing that idea. But right now, I would say we're going to go above 5, and then that will be about it.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. That is fascinating. You know what? I think, at least you're the first on this show that's explained all of the different meetings, and the door will effectively be closed, bust, as you put it, if you don't do it by June because you get way too close to the election. I also just noticed the FOMC is that Thursday after the elections, after Tuesday when we all vote. They'll have the meeting then in November.
So, yeah, 2 quick things about that. What I want to be clear on what I'm saying is that the Fed doesn't change policy, in the summer and up to election day. Change. If the policy was cutting, they could keep cutting through the summer. If the policy was hiking, they could keep hiking through the summer. But the policy going into summer is hold. So they'll keep holding until election day. And as far as Thursday, November 7th, yeah, there's a meeting there. I mean, this cynic in me suggests, look, are we going to know who won on Thursday, November 7th? Is the Fed still going to be political?
Yeah, doubt it.
Yeah, is the Fed still going to be political by cutting rates? Again, if the data warrants it, the data's got to slow first. Mm-hmm. If the data warrants it at the November 7th meeting. So, they could be right in the middle of that mess. We collectively could be in the middle of that mess as well.
Okay. So you were mentioning on rates, 5 to 5.5%. Can we explore that thesis and the implications, what that could mean for various assets and where you might want to be allocated?
So for the stock market, let me mention it. Before I talk about the assets, let me give a preface on this. The natural state of an economy is to expand, is to be positive growth. Why? We're a capitalist society. What most people listening to us are investors. What does an investor do all day long? They take money away from bad ideas. They give money to good ideas. That's why the natural state for an economy is to expand. What causes a recession? Rudy Dornbush, who's an economist at the Federal Reserve, famously said, expansions of an economic expansion does not die of old age. It's murdered. Something comes along and murders it or breaks it. Now, the big culprits in the past have been a spike in oil prices because of a supply shock. The Iraq invading Kuwait in 1990 comes to mind. Financial crisis, 2008. I was going to say 1980, maybe I'll leave, but I'll just go with 2008, the financial crisis. Some geopolitical event, let's call that COVID in 2020. That could be another thing that comes along out of the blue and murders the economy. Suffocatingly high interest rates. So this was the twin recessions in 1980 and 1982. So So the natural state of the economy will be to expand unless we get one of these murder events that comes along. Look, it could be geopolitical, it could be political, it could be the election, it could be, that we're just, civil war after the election or something like that. I hope it's not. It could be anything else. But one of the things it could also be is suffocatingly high interest rates. What is clear about 5% interest rates is they're not suffocatingly high. There's no data, there's no evidence within the data on labor or the economy or financial markets that they're really hurting because we're at suffocatingly high rates. So yes, we could continue to move higher, and 5.5, I don't think is going to be that suffocatingly high level. With that said, it seems like once we got over 450 and the 10-year note, right after the CPI report beat 2 weeks ago, April 11th, the stock market started to basically be bothered by it. It's corrected 6%. It's attempting to, change that correction now by rallying the last couple of days right before we were recording. We'll see if those rallies hold. But if rates are going to continue to move towards 5%, and I'm careful in this word, it's going to bother the stock market. It's going to keep it trending a little bit down to sideways. It's not going to be a terrible correction or anything. A terrible correction would come if something else like that murder weapon comes in and really hurts the economy. So gains in the market right now is going to be kind of difficult to get because you're going to have that high interest rate. Lastly, Dr. Jeremy Siegel did an update to his book, Stocks for the Long Run, last year with Jeremy Schwartz, his co-author, co-CIO of Wisdom Tree. In the book, they said, what is the expected return of the stock market? So if you did the Warren Buffett thing, you bought the S&P 500 and you said, I'll check it in a decade to see how it's doing. It would be 8% a year. That's what they estimate. All right. You might be 16% 1 year, 0 the next year, but it will average about an 8% gain. Okay, that seems reasonable that you should expect about 8% a year. Well, what about the bond market? Yields on the bond market right now, if you look at the Bloomberg Aggregate Index, are slightly over 5%. That's its long-term potential or long-term return is 5% on the bond market. That brings up an interesting dynamic within the markets right now. And let me start it by this way. In 2019, when that Bloomberg Aggregate Index was under 2% and money market funds were at 0, everybody screamed, Tina, there is no alternative. You can't be in bonds, can't be in stocks. They don't yield anything. I'm sorry, you can't be in bonds, you can't be in money market funds. You have to be in stocks because bonds and money market funds don't yield anything. So we had all this big push of money to go in. Well, today, bonds yield 5%. Money market funds yield more than that because of the inverted yield curve at around 5.3%. So you can get 2/3 or maybe up to 70% of the expected return of the stock market. And in the case of a money market fund with no market risk, because the money market fund's NAV, its price every day is $1. It's the same price every day. And its yield will give you more than half of what you would expect out of the stock market. A bond fund will give you 2/3 of what you would expect out of the bond market, out of the stock market. And a lot of people are saying, sign me up. I'll take that reduced risk, big yield. And even in the case of the bond market's off to a terrible start this year. It's down 3%. Boy, the stock market could lose 3% in 3 hours. And so even though the bond market's in a terrible place, because of that big yield, it's only 3%. And that's a bad year for the bond market. So I think that as these yields go to 5 to 5.5, it's going to be hard for the wealth management community or stockbrokers or anybody else to be screaming, there is no alternative. You have to be in stocks. No, there is an alternative. There's a big, fat, multi-trillion-dollar alternative. And it's called the bond market and money market funds. And yeah, you might be right. I could get more out of the stock market, but I take a lot more risk in the stock market than I take here. I could get most of it with a lot less reduced risk.
That's so interesting. It also makes me wonder, and this might be a really silly question to ask, but it makes me wonder, like, okay, a lot of the asset holders, I'm going to assume a lot of them are probably boomers, like that age. They're probably getting close to retirement. So they're not in like, they're, investing, growing. I wonder if it's going to be more of like they want to harvest or maintain their returns. I wonder if maybe you would see it across, demographics where that might shift.
Yes. No, I mean, you're absolutely right. All the studies do show that most of the money is owned by boomers. And if you look at, say, Vanguard really pushed this. There's these things called target date funds. And they have them every 5 years. So there'd be, 2025, 2030, 2035, all the way out to 2065. Pick the year you want to retire, say 2050 or 2045, and you buy the target date fund. There's like $3 trillion in these funds. And what it does is it puts you in a mix of stocks and bonds. And as you get closer and closer to retirement, the percentage of stocks goes down and the percentage of bonds goes up. They then have another fund called the retirement fund. So let's say you were in the 2020 fund and you're an old boomer and you're in your 70s and you still haven't retired. Well, we're past 2020. They close that fund. They put all your assets into what's called the retirement fund. And the retirement fund's like 80% bonds is what that is. Because remember, what is a bear market? A bear market is time. It's not price. So if you go to a boomer who's, say, 65 years old, and according to the mortality tables, they got 15, 16 more years left, maybe more if they're healthy, but let's just go with 15, 16 more years. And you tell them, oh yeah, higher rates, the market's going to struggle. We might have a period of 2 or 3 or 4 years where we were going to go sideways. That's a third of my existing life left, 2, 3, 4 years, or up to a third. Maybe it's 20% or something like that. That's intolerable. I'll stay in bonds. If you're 35 years old and you say, look, the market's going to chop around for, 2, 3, 4 years, fine. I'll just dollar cost average in all the way. And then after 3 or 4 years, I'm ready for the 15-year run higher. And so, yeah, that's also the other problem too, is that as bonds become more competitive with stocks, a lot of the money is owned by older boomers, and they're very happy in staying in bonds. If I could, throw in one more analogy to the crypto community, the Bitcoin ETFs being booming and a lot of people talking about them, they say if you don't own crypto, have fun staying poor is a line you hear a lot. And I have to remind them, old boomers that use wealth managers aren't poor. They've already got the nice car. They've already got the lake house. They are doing very fine. Their wealth manager's job is to not lose money. And their second job is to not lose money. And their third job is to not lose money. So when the bond market offers you an income with very little downside, it becomes very, very attractive. This is not 2019 when you turn to a boomer in 2019 and go, look, you're not going to get anything if you stay in the bond market. You got to take some risk in the stock market. Yeah, but what if it goes down and it takes 5 or 7 years to recover? I know, that's half my existing life expectancy. I don't have 7 years to wait just to get back to even. And so, yeah, that's going to have a profound impact on investing. And it is, because if you look at bond fund flows and money market flows for the last year and a half, they've been huge. Money has been flying into those instruments way more than stocks. They are the dominant inflow instrument right now.
Jim, you mentioned the Bitcoin ETF. I want to get your take on that. It sounds like you have a critical point of view on it. Unpack that for us, the Bitcoin ETF, and what do you think it's going to end up doing to Bitcoin ultimately?
So I have a nuanced view on this. And so let me start off at the top. I'm bullish on Bitcoin, and I am bullish on the whole crypto space as an alternative financial system. I've been long Bitcoin since 2017 in various forms. I still am now, and I still will be. What I think this space is trying to be is an alternative financial system, starting with an alternative currency or medium of exchange or store of value, whichever you want to call it, whichever crypto we're talking about. Let's stay with Bitcoin, an alternative store of value. And what it needs around it is an entire ecosystem of an alternative decentralized financial system. The Ethereum blockchain is trying to do that with DeFi. You're starting to see that come in on the Bitcoin blockchain as well too. They had BRC20s, now they got runes. They're trying to bring DeFi to the Bitcoin blockchain as well. Good, good, good. That's exactly what it needs. And it needs to be decentralized so it could never be permissioned and it could never be censored. Good, good, good. That's what I want to see. That's why I'm here. The Bitcoin ETFs come. Okay, fine. It's a tool like many other tools. We've got Bitcoin futures ETFs, and we've got some, we had a closed-end fund with Grayscale. That's fine. But it took a life of its own. This is the adoption tool that's going to get every boomer into Bitcoin and orange pill them, and we're going to go to 200,000 or 300,000 or whatever big number you want to put out there. You're losing the narrative. This is the nuanced argument I have. You're getting away from being the alternative financial system. You're arguing that this is an orange FOMO chip, and we're going to see all the boomers FOMO into this and push it higher. If that's what you're hoping for, Dylan LeClaire, here come the boomers. Man, they're not coming. And actually, if you look at the data, because they all these wealth managers have to file these 13Fs, less than 1% of the Bitcoin ETF is in wealth managers' hands. 25% of it is GLD is in wealth managers' hands, less than 1% for the Bitcoin ETF. If you look at alternative assets like the high yield one, it's 75% is in wealth managers' hands, less than 1%. That means 99.5% of those assets are not in boomer wealth managers' hands. And what I'm worried about is that they're stuck in paper-handed degens. Now, degens exist in the TradFi market. They're huge in the TradFi market. Actually, degens in the crypto market are very small. These people are out to make a lot of fiat real fast because they want to buy a neon Lambo. They're not interested in the alternative financial system. They're not interested in a store of wealth. They're interested in number go up, and they're interested in hopefully a greater fool theory that there's going to be some kind of FOMO chip. And that's what the Bitcoin ETF is being sold as. And my concern is you're losing the narrative. And if you're going to lose the narrative, it's going to be very disappointing. You got to get back to ground zero. We want an alternative financial system. We want an alternative store of wealth. Also, the other problem I have with it too is Bitcoin's issuance is decentralized through the blockchain. But if its ownership is centralized, good, all the boomers are going to own it in the Bitcoin ETF. We're going to push it, FOMO it higher, fine. And then just like the gold window in 1933, one day Gary Gensler or whoever follows him is going to come in and say, it's banned, you're locked out of your accounts, can't touch it anymore, and they're just going to basically make it illegal because they can. But if it is truly in a decentralized ownership, that can't happen. And I've also been critical by saying, to me, all of this excitement about all this money going into these ETFs represents some form of failure. Look, you guys have tried for 15 years with wallets. And you've tried for 15 years with centralized exchanges, and you've tried to build something a little bit different. And the public here has said, not interested, would rather own it as an orange poker chip in my brokerage account right next to my high yield fund in Spiders. And so we're not getting to the narrative of what we're trying. We're not getting to the end goal of trying to build something purely different than what we have right now. Gold had this same issue happen to it 15 years ago. GLD came along, and GLD became really excited because all the boomers could buy it in their wealth management accounts. And like I said, 25% of it is. Remember, GLD started in 2006, so it's had 18 years to get rolling with this. But by bringing it into the fiat system, it became part of the fiat system. And gold has been a very frustrating investment until about 2 months ago, when it finally started moving on Asia demand, because it traded like a fiat currency. Because effectively, by getting everybody to buy it through an ETF, you turned it into a fiat currency. If you're not careful, you're going to turn Bitcoin into a fiat currency too. It might buy a decentralized issuance through the blockchain, but if everybody owns it the same way they own GLD, it's going to be a fiat currency. And it's going to be, it's only going to rally when the dollar weakens, and when the dollar strengthens, it's going to go down. It's going to be another frustrating investment. It's supposed to be something different. And as long as you're trying to move towards it, something different, I'm all in. I'm still there. I don't think we've ruined it. I just think we're losing the plot here, and we've got to focus back on the plot. And just to get all excited that we're just basically going to give all the boomers this orange FOMO chip and tell them all to panic into it. Remember what I said before? Boomers already are rich. They don't hand $5 million to a wealth manager going, I'm 61 years old. Can you make it 20? Oh yeah, we could buy you a bunch of Bitcoin because that's got some upside potential. No, they hand them $5 million and they tell them, don't make it 3 is what your job is. And second job is don't make it 3. And, as far as should we buy some Bitcoin, I don't even want to own stocks. I want to be in bonds because they give me a yield because I only got 18 years left to live. That's the way that they tend to think about this stuff. And that's why I think that the community is completely missing the point. Yeah, it's a fine tool. I'm not against it, but it's just one of the course, but it's kind of consumed everybody thinking that it is the tool for boomer adoption.
You still like Bitcoin, you still own Bitcoin, but it's just moved. It's lost the narrative of like what it was supposed to be by going this route.
Yes, exactly. And I think, it will, I hope it can get that narrative back. I want to hear more from developers. I want to hear more ideas like runes and stuff like that. I think any of this stuff, I'm always excited about that kind of stuff. New adoptions, new ideas, new creativity. That's what's going to continue to move stuff forward and to get people to go that way. Also, the other thing I fear too is that a lot of people think, well, this will be the gateway drug to getting everybody, well, they'll buy some Bitcoin, it'll go up, they'll get interested in it, and then they'll open an electronic wallet. No, I think it's going to be the opposite. I think they're going to buy some, it's going to go up, and the people in electronic wallets are going to go, man, this is hard. I'm just going to sell it out of my electronic wallet. I'll just go buy IBIT, in my Fidelity account, because that's simple. I think you could actually see it go the other way, and you could see the online demand shrink for this other demand that would be basically in the TradFi world. And that could have, I think that Bitcoin needs some true L2s, more than just the side chains that it has right now. And if they have to compete, if you want to try and build true L2s on Bitcoin, and you got to compete with the Fidelity and the Schwab brokerage accounts with the boomers, it's going to be harder to get those things done. And that's really needed so that you could really see a world of an alternative financial system. It is not enough to just have a decentralized asset with a low inflation rate that has just been halved last week. That's great, but it's the beginning of the process. Too many maxis think we've hit nirvana and that's all we need. We just need this asset with a low inflation rate and a hard $21 million cap. We are done. There's no more work left to be done. That was the start. And we need to see more built around it in order for it to truly meet that $1 million goal that everybody wants. It's not going to get there because everybody's going to FOMO in with the orange chip. It's going to get there because they're going to be looking at what's happening and going, this is where we're going to be in the future when it comes to the financial system. And that's how you wind up getting to $1 million on Bitcoin.
Totally. Well, Jim, I always love having you on. You have the best energy, the best ideas. Can I give you the final few moments here to share more where folks can find you, find your work? I know you have an ETF too. I don't know what you can say on that. And any parting thoughts, anything that you want to reinforce or bring up that we didn't in this episode, please take the next few minutes to do so.
Okay. So I'll start off with BiancoResearch.com. We are an institutional research service. You can check out our website, request a free trial if you want. I'm active on social media. Bianco Research, I use that handle for Twitter. Bianco Research, I use that handle for YouTube, Jim Bianco on LinkedIn. Those are the three that I'm on. We started an ETF. You can find out more about it at Bianco Advisors, not Bianco Research, but BiancoAdvisors.com. WTBN is its ticker. Wisdom Tree is my partner. It is something a little bit different than what we've been discussing here. It is a fully invested fixed income ETF seeking to outperform like the Bloomberg aggregate, because I've been a bond guy forever and ever, like the Bloomberg aggregate and like those other alternatives. We're presenting ourselves as, for people that need to invest in the bond market or want to invest in the bond market, it is the largest asset class in the world. We're going to offer an actively managed index and an ETF that is tied to it. BiancoResearch.com, BiancoAdvisors.com explains all of that right there. So that's what we're doing and where we are. As far as any other thoughts that I have right now, no, that's pretty much it. Those are my big themes. And the thing that I would definitely emphasize right now is what we talked about at the beginning. The shift is coming. That in the beginning of the year, we were talking about recession or soft landing and 2% inflation, and we're off that. And what I suspect will happen, if I'm right and we do eventually realize a 5% 10-year note, get out of the way. Watch how bearish everybody's going to be. And by the way, watch how bearish everybody in the crypto space is going to be about the bond market. They're already out of control bearish on it right now. And then they're going to be gloating when they get the next 30 basis points of confirmation. And that's why I think that if we get above between 5 to 5.5, I think that's about it for the decline, for the rise in rates. Now, I don't think we're going to have a new bull market in bonds. I think, but we're going to see them trade off, back off and stuff. And kind of gives you an idea where I'm going to go with this fixed income ETF as well over the next few months.
Well, Jim Bianco, president of Bianco Research, thank you so much for being so generous with your time, all of your ideas, your knowledge, your wisdom. I really appreciate you coming on again. Thanks again, Jim.
Thank you.